Welcome to This Explainer. Today, we're tearing down the strategy of the Walt Disney Company. And honestly, Disney is at a wildly complex crossroads right now. On one hand, you've got record profits and massive box office wins. But on the other, a stock price scraping 15-month lows. It's a total paradox, and it's exactly what we are going to decode today.
So, is this iconic media empire on the brink of a historic turnaround? Or is that struggling stock price flashing a giant red flag? We aren't just skimming the surface today. We're going to act like financial sleuths and examine the evidence, piece by piece, to see exactly how management is navigating this whole new era.
Here is our roadmap for today. We're going to logically build our case by moving through the Q3 earnings, the big strategy and restructuring moves, asset sales, the new TikTok growth experiment, parks and box office performance, and finally, the ultimate outlook, turnaround or red flag. Let's dive in.
Starting right at the foundation, Section 1, Earnings, the mixed picture.
Right off the bat, the dichotomy here is literally crystal clear. Looking at the top row, Disney comfortably beat Wall Street's expectations on the bottom line. They brought in $2.06 per share. But right below that, they slightly missed the top-line revenue forecast, bringing in $25.25 billion. So you've got really strong profits, but slowing top-line growth. But wait, here is the number that absolutely matters most. A massive 31% jump in operating income year over year. That surges to $5.56 billion. What should you take away from this? Basically, it tells us that even with revenue slowing down, Disney's operational efficiency is just ruthless right now. They are squeezing significantly more profit out of every single dollar.
Moving right along to Section 2, Strategy, Restructuring and Merch.
So, how exactly is management reacting to those top-line pressures we just saw? Well, starting in fiscal 2027, Disney is doing a radical reorganization. The old model used to house consumer products, your favorite toys and apparel, under the experiences segment, right alongside the theme parks. The new way? They are ripping that out and placing it directly into the entertainment segment.
And why this massive shakeup? It's all about speed and synergy. By putting the merchandising teams in the exact same room as the creators at Marvel, Pixar, and Star Wars, they want to create instant retail moments. Think about Toy Story 5's billion-dollar run. Having the studio and merch teams totally locked in step drove record toy sales right alongside ticket sales. This isn't just corporate cost-cutting, it's a structural offensive.
All right, Section 3, Capital. Asset sales and buybacks.
Beyond that internal restructuring, Disney is making some pretty aggressive external moves to trim their legacy weight. They're selling their 50% stake in A+E Global Media, which means legacy cable networks like Lifetime and the History Channel, to Hearst for $1.2 billion in cold hard cash. They are purposefully limiting their exposure to the dying linear TV model.
And what exactly are they doing with that $1.2 billion? They're funneling it straight into an expected $9 billion in share buybacks. I mean, when a management team aggressively buys its own stock at 15-month lows, they're sending a glaring signal to the market. They're putting their money where their mouth is to say, hey, we believe our stock is drastically undervalued right now. Next up, Section 4, Growth. The TikTok experiment. To combat those slowing revenue numbers, Disney is looking directly at Gen Z for fresh growth vectors. Enter Verts. This is a highly experimental new feature on Disney+, built in direct partnership with TikTok to bring curated, short-form creator content straight to their streaming platform. The logic makes total sense, right? You have to meet younger audiences where their attention actually is. If they want infinite scrolling, Disney is going to give it to them to stop subscriber churn.
Let's quickly check the pulse on Section 5, Performance, Parks and Box Office.
While they're experimenting digitally, how is their traditional cash cow actually holding up? Well, it's a bit of a nuanced picture. International parks remain a mixed bag, with attendance basically flat right now. But domestically, the U.S. parks are holding the line, showing a solid 3% year-over-year growth in attendance. So that core engine is definitely still humming. And on the silver screen, their content pipeline remains an absolute juggernaut. We already mentioned Toy Story 5 joining the billion-dollar club, but Spider-Man Brand New Day just opened to a staggering $927 million worldwide. That almost broke the Avengers Endgame opening record. When Disney Studios hit their stride, they literally hit bigger than anyone else on the planet. Finally, Section 6, Outlook. Turnaround or red flag? So, we've looked at the mixed earnings, the strategic pivots, the cash moves, and those massive IP wins. What's the final verdict? Well, despite the stock hovering near those 15-month lows, Wall Street analysts actually maintain a moderate buy consensus. They've got a price target of $127.59, which suggests roughly a 15% upside from where it's trading today. But as focus learners, we really have to weigh the scales impartially here. The risks? They are very real. You've got top-line revenue misses, macroeconomic pressures threatening park attendance, and the huge execution risk of totally reorganizing their merchandising arm. On the flip side, the bull case is anchored by an undeniable moat of intellectual property, $9 billion in stock buybacks, and a bold leadership team aggressively trimming legacy cable to adapt to a TikTok world. So based on all the structured evidence we just explored, the final question goes to you. Are these painful, massive pivots exactly the right medicine Disney needs for a historic long-term turnaround? Or are slowing revenues and cable sell-offs the early tremors of a crumbling empire? The pieces are all on the board. Think about how you see this playing out. Thanks so much for joining this explainer, and we will catch you next time.